Welcome back. Now, South Africa has struck gold. Finance Minister Tatonga's decision to draw on the gold and foreign exchange contingency reserve account to help stabilize the economy has reduced fiscal fears. Interest rate cuts are on the cards, as well as the anticipation of a smooth election. This mix prompts the Bank of America to believe that the country may be in for a credit rating upgrade. Tatonga Rusike, SSA economist at the institution, joins us now with more detail. Thank you so much for your time, Tatonga. Now, it does seem that things look a little bit better for South Africa, but I want to zoom in on sentiment first, because I do understand that at the investor conference, local and foreign investors were there. They also got to interact with some of the JSE listed companies. And I mean, at these gatherings, you get to gauge where investor appetite and business confidence is. And, just looking at what was prevalent at this year's conference, what stood out for you in terms of what investors and companies are saying about South Africa and what they're looking at?
Thank you, Zinati. Good morning to everyone. I think if we start from the perspective that non-residents or foreigners have been net sellers of South African bonds and South African equities until now. So for last year, 2023, as well as 2024. So it is a question that they are looking at what point do you actually re-engage. You are looking at two factors, one on the global side and then on the domestic side as well. Globally, I think the US has been doing well. The expectations that the central bank could actually change tact and start cutting, perhaps in the middle of the year. If they start cutting, you could see dollar weakness, and emerging markets, including South Africa, could stand to benefit from that pivot. Then secondly, on the South Africa domestic front as well, you've got a couple of things going with the budget in February. You've got elections still coming up in May, and potentially rate cut cycle. So all of those factors play into investment decision that investors would be looking to say at what point is a good time to re-engage, given that they've been largely exiting in the past few years. So we're at a time where we are probably closer to an increased re-engagement.
All right. Well, actually, let's zoom in on the rate cuts, because today we actually did get the inflation print for February that ticked up from January, 5.6% at this point, getting closer to the upper limit of that range. We do have the MPC meeting next week. And I'm wondering, obviously, you talk about these rate cuts, but I'm wondering what happens between now and then, and when is then?
Yeah. Okay, so the inflation print for today, I think, is largely about services, where we saw services inflation increasing above our expectations. We expected to see headline inflation around 5.5%, came out 5.6%, so a touch higher, but largely driven by increases in medical inflation as well as insurance services as well. So those were the primary drivers that you would say resulted in that. But that in itself should not spook the sub, particularly for next week. I think to change tact, they are firmly, I think, in a hold position. We are probably done with the hiking cycle, so we shouldn't worry too much. There could still be some upside pressures as well in the coming inflation prints. But we do see that inflation in the second half of the year is likely to moderate and be, let's say, for the full year, averaging around 5% compared to last year, where inflation was averaging 6%. So we are probably in a better place this year compared to last year. So we do think that going into next week, we are not likely to get any signals from the sub about any discussion of voting for rate cuts yet. So it's likely that you will see a unanimous hold and a strong hawkish turn for March. Then May has got elections. That's why we think our best line that for July is probably right for now. No need to change that, so that we need to go through two MPC meetings, and then perhaps you'll have better inflation prints that will now support the argument much better. So for now, it's probably firmly hold for next week.
What is your view on the rand and its impact on the interest rate cycle? Do you think that the risks are maybe to the upside or maybe limited at this point?
Yeah, look, I think it is driven by two things. One is fundamentals, which you look through the domestic numbers, such as current account, inflation, and all of that. But the other is also positioning about moves by foreigners. So you do see that the dollar has been strong for quite some time. And potentially that if we could start to see some of that dollar weakness, it could translate into rand strength. So today you would see the rand trading closer to 19 per US dollar. We think that the rand is probably likely to be around 18 towards year end. So we're expecting the rand to actually strengthen, and that is positive for inflation projections. So that would also come consistent with the view that you're likely to get inflation closer to the midpoint target for the SAP. So we do see that perhaps at this time it's likely undervalued because the dollar has been too strong. So that pivot could actually help the currency outlook as well as inflation outlook.
Yeah. In the intro, I did mention obviously the expectation for a credit rating upgrade. And I'm wondering if that all has to do with the GFECRA account and maybe just cooling down nerves on the fiscal metrics of the country at this point.
Yeah, look, I think there are no expectations at this stage about a credit rating upgrade. That is number one. But what we are saying is fiscal fears have been reduced going into the election because the budget turned out better.
Yeah.
Thanks perhaps partially to less borrowings as there are drawdowns on GFECRA, so debt service growth would be much less for next year compared to the previous years. And you are starting to see increased investment perhaps in the energy sector that helps with better electricity supply, and moving on to allowing private sector participation, particularly in the rail network for transport. So that could point to perhaps upside potential on the growth outlook. So reduced fiscal fears, upside potential probably presents us in a position where you would say, given probabilities, you are likely better to get upgraded to BB than to be downgraded into single B category. We're not necessarily saying that this is the next step of action, but if probabilities as these things materialize, perhaps we could get there rather than downside, but we need to go through potentially a smooth election.
All right. Well, thank you for that. Of course, this does provide, a sigh of relief, but maybe not time for us to pop out the champagne yet. Thank you so much for your time, Tatonga. That was Bank of America's SSA economist, Tatonga Rusike.